Okay, guys, welcome back to Basics. Are you bored of us yet? So again, if you're new here, please go back on the channel. Both of ours, we have playlists from 1 to 30, right? So it will help get you caught up. This is a series where I'm taking my lovely fiance, soon-to-be wife.
So soon.
Maybe, well, if we stay behind, you may miss that, but in the next month or so, teaching her how to trade from the ground up. So this is a great series for people who want to refresh the basics, or you're just getting started trading, right? This is how everything works. And then we're going to go actually paper trading and building trading plans soon. Last two things to cover are derivatives. You excited?
Oh, yeah.
So I have, if anyone follows me on Twitter or anything, I actually have 8 letters after my name, and they're all based on derivatives. So academically, I know a lot about this, but I don't actually trade these myself. But I thought I would introduce them to you because they may resonate with you. It's not like there's anything wrong with trading these. It's just not the style that I've kind of built over time. And again, I apologize. We should close that in a second. But we're getting some work done to the backyard. So if you hear something from time to time, I installed a noise gate. So I hope that helps. But if not,
Sorry.
It should be done soon. So here's our channels. Come, if you're on my channel, Jessica always has whatever the next episode is, so go check it out there. And if you're on her channel and you want to learn more, I try to make sure that everything I put on mine is educational in some way, shape, or form. So go check us out. Futures contracts. So do you remember ETFs from last time?
I'd be lying to you if I said I did.
Okay. So remember, an ETF was just a combination of instruments. So, the S&P was 500 of the top stocks.
Right. Yes.
Gold was just like physical gold held somewhere. So those are ETFs. And part of the problem with those is that they are managed by someone else, and you have to pay those people. So they have management fees involved with them and things like this. So there's an additional instrument that does almost the same thing but has some advantages, and we'll go over those now, and those are futures contracts. So first, and this is kind of important, is here's kind of the dictionary definition. So a futures contract is an obligation between two parties to transact, to trade some instrument at a predetermined date and time and price in the future. And obligation is the key word. So that will make more sense in a second. But here's why they were invented, and this is usually a pretty good one to make people understand them. Imagine you're a wheat farmer. Look how happy that wheat farmer is. I was very happy that I found that picture.
Were you as happy as that wheat farmer?
I don't think anyone is as happy as that wheat farmer. So if you're a wheat farmer, you're growing wheat. I don't know how long it takes to grow wheat. 3 months out, for example, right?
Okay.
And you want to make sure that you can sell that wheat at a price that you like, that you're okay with. You can't control the prices because wheat and all these things are publicly traded. So it's worth what it's worth, right? Same as anything else. But if you liked the fact that wheat was at the price it was now, and you wanted to make sure, you wanted to protect against a decline in price, you could go out to this futures market and go out 3 months and sell the wheat for whatever it's trading right now. So you're saying, I'm going to produce 1,000 bushels of wheat. Let me go to the market and sell them, right? And then the other way, imagine you're a baker, right? So as a baker, it's completely the other way around. You need to buy wheat to make bread. So if you're okay with the price the way it is now, and you need to buy 3 months worth of wheat to make your bread, you would go to the, right? And you would transact. So what this created was futures market. And this is actually, remember how we talked about how candlestick analysis came from rice traders. That was kind of the original market for this kind of thing. So that's what the futures market is. Basically saying, I want to lock in a price for that future, and I want to do it depending on what side I am. Now, what we found is that, right, there's not a baker for every farmer, right? There's not a, someone who needs gold for everyone who produces gold. So what happens a lot of the time is that traders like me and you are actually in there trading and speculating on these, and that helps the farmer and the baker buy and sell it. So that's the point of them. It's basically secure a price into the future, and these contracts are traded forever. and all the time they're 24/5. So they're open Monday to Friday, basically 24 hours a day. So at any time, this farmer could go down and say, okay, I want to sell 1,000 bushels of wheat for July at this price, and then they're done. So the benefits of futures trading. So we are not a baker nor a farmer, but what we are is someone who wants to speculate on the change of prices. What's the benefit of trading futures over stocks, right? And this is what both of these lessons for futures and options are going to be about, is what's the difference between what I've been teaching you normally. Super high leverage in the futures market. I think 10 or 20 to 1 you can get. So if you really want to be aggressive, you can do that much better in the futures market. Part of that, the reason behind that, is because of the 24/5 type of markets, right? It's a lot easier for them to get you out of a position that goes bad when they're open all of the time. Huge liquidity. Essentially, that just means, we talked about liquidity and volume, your ability to get in and out at whatever price you want.
I just have a quick question.
Yeah.
Are you allowed to do this with Bitcoin?
Yeah, there are Bitcoin futures.
Huh.
Yep.
So like when it was at like 25K, if you would have bought a future Bitcoin, like how does that...
Well, you would have sold at that price and said, I want to
Yeah.
provide you, and you got to remember at the end of that contract, they're either what's called physically settled or cash settled. So physically settled means basically we were writing a contract that, say, for $10 a bushel, I'll give you 1,000 bushels of wheat in December. So physically settled means I'm actually going to bring the wheat to your house.
Okay, yeah.
Right? And you're going to have cash settled means we settle up for whatever the cash value of those instruments are at that time. And yeah, you could do the same thing with some exchanges with Bitcoin, where you say, I'm going to deliver you 10,000 Bitcoin at this future date. And that would make sense for miners. Like, I was involved with a miner for a while there. And that's a lot of what I did.
I was just curious if it worked, if it was in the Bitcoin market as well.
And it's because they're just contracts between two people. In theory, you can do them with anything. Now, there's a lot of regulation and everything involved to make sure you're not running a scam, but you can do them with just about anything. So then the 24/5 markets are great, because if you want to buy a future and you want to set out the stop loss, you don't need to worry about these gaps as much. They can happen over the weekend. They close usually at 5 on Friday, our time, and then they open up at 6 or 7 on Sunday night. And then they trade through the week. And then easier to short. So the thing is we talked about shorting a stock, is you need to go find some stock to borrow to short that stock. And sometimes there's none out there, which just means you can't short and move on to your next idea. What you can do with futures is since you're writing a new contract, you can just make unlimited amount of contracts. So you don't have to borrow anything to short. You're just writing a contract saying, I'm writing the obligation to sell this instrument at this time. So you can short whatever you want. The drawbacks are about the same as the other one, where there's high leverage, right? That's either a good thing or a bad thing, depending on how you use it, right? Huge liquidity also means less movement on average. The more something's traded, the less it moves. The more it's close to what that fair value that everyone agrees upon is, it is. And then a limited selection, right? You can trade S&P futures, so that basket of 500 stocks. You can trade Bitcoin futures, orange juice hogs, pork.
Okay, but you can't go to like a specific stock?
No. Okay. There are some ways you can, but not really. So it narrows it down. So you're again not betting on companies, you're betting on groups of companies, or you're betting on commodities, right? Oil, gold, silver, wheat, things like that. So the ES versus the SPY. So you can see this is on the left, that ETF, the SPY that we talked about, which is the 500 stocks. Over here is the futures version of the same thing, right? So it's the same. So the main difference that you'll see is that there's just less gaps. Right, so from here to here, there was a gap, right? You see that was just one move because it's open longer. So there's less gaps. So it means you could have actually transacted in this period here on the futures market, but not on the SPY. Again, if the mic's picking that up, sorry, it will be cleared up in the next few videos. Right, and the last bit for this one is Forex trading, which goes along with futures trading, and you can do this in the futures market as well. And Forex is just trading other currencies. So again, if you want to take a bet of the Canadian dollar versus the US dollar, or Singapore versus Hong Kong, or whatever it is, and they existed for the same reason. So I'm Canadian, and a lot of what I do trading the US markets and consulting for US companies, I get paid in US dollars. So if I wanted to do some sort of a hedge against my own income, I could go to the market and do that. And that's something that big companies do all the time. Apple is an American company, but if I'll go give them Canadian dollars for a computer, they'll then give that to a bank that will then convert that back into US dollars. FX market is huge, and you can see a lot of the benefits are the same, right? Huge leverage, huge liquidity, 24/5 markets, and super easy to short sell. When I say huge liquidity in Forex, I mean huge. There's an old adage that little guys trade stocks, big guys trade derivatives, and that's futures and options that we talked about. Institutions trade bonds. We haven't gone over bonds much, but you get the basic concept. You buy a bond and it pays you a bit of money, and then it gives you, right? You're the other side of debt. And then countries trade FX. So it is by far the biggest, most liquid market out there. And again, the drawbacks are the same type of thing, right? Where the huge liquidity means often there's not very much moves. I put more extreme moves on this one and the other one because quite often if there is a big move in, say, the Canadian dollar, it's because something has done something dramatic to affect the country, and those moves are just insane. Like, so Forex and futures will do nothing for long periods of time and then big moves because something fundamental has changed. And then the limited selection, no one's really trading, the Kiwi much, which is the New Zealand dollar, right? There's like US, Canada, Euro, pound, right? And you've got 5 or 6 big currencies, and that's it. Again, the advantage of trading these things is that there's less things to focus on, but that also requires more patience. So as you know, when you're scanning through your stocks, sometimes it's hard to find a good setup. And it would be more so in these markets because there's less of them to go through. What you lose there, you gain in the fact that you could buy as much or as little of the companies or the things as you want. So this is the Canadian dollar versus US dollar. Again, I just want to show you that the charts look the same, the candles are the same, the setups may be the same, right? There's no difference to them other than what it is you're betting on. Make sense?
I think so.
That was just kind of me chatting on you for a while. No questions about derivatives?
I don't think so.
Okay, that one was fairly straightforward. The next one will be a little bit more complex, but we'll see when we get there. I should say bye. Bye, everyone.